And hello, welcome back to another video on how to secure yourself financially. You may wonder, it's like, hey man, are you on coke? No, at all. Just is I recently go to the gym, and that's the reason why I'm so active. So, looking now at the investing classroom for Morningstar, this North American financial service firm that offers management service and investors education as other service related to the financial sector. Here in the featured content, which is one of the 7 course on how to secure yourself financially, or from the investing classroom. And uh, inside of this, well, I look at staying invested in the market. The things to know is that stock has provided the increase in the wealth and uh, high good returns over years by looking at this historical graph over the last 94-year examination of past capital market return. That investor must have discipline and patience, and especially by looking at how the market behave after the end of a recession, that even though that after it has passed through, or after a recession, that it might take several years, the after the end of that recession, of that consecutive period of negative stock return, on average the stock performed above average positive uh, return. Again, this is a pattern that happened in 1929. Sorry, this is a pattern that happened in 1930 in 1939, uh, and in the 1973 during the Yom Kippur War, performed by the Petromonarchy to U.S. to Israel, because they were supporting Israel. So the U.S. were supporting Israel forces. So the Petromonarchy make a U.S. oil embargo to that. But in any case, especially on downturns, uh, it is important to follow a set of recommendations that Morningstar give you, like maintain a well-diversified portfolio and a dollar cost average strategy. So by having a diversified portfolio, that won't guarantee to eliminate risk, but it can help you to minimize as much as possible by having investment on different companies, perhaps in different fields. And the DCA is just a way to continue purchase regardless price fluctuation. Again, this won't protect you or ensure you profit, uh, especially in sorry, especially in downturn markets, right? But again, the things to know here is, well, investors must have discipline and patience. Also, I looked at holding on can pay off in the long run, which is great. And after the end of a recession, after the end of a recession, how on average small cap stocks, which are stock whose market cap is around 250 millions to $2 billion, and this small cap stocks, on average, after the end of a recession, outperform those of the large stock. After 1 month, 6 months, a year of that. And then look at the interest rate. So what is interest rate? Which is the charge you will is the charge you get, or is the amount uh, or is the cost of money, is the cost of borrowing money or savings you will earn. Uh, and how the Federal Reserve, which is the U.S. Federal Reserve, was created in 1913, and it is a very interesting story about the reason why they made that. Because there's something called the Bank Wars in 1850, so that lead us to now the creation of the U.S. Federal Reserve, and now we inherit that. And most government copy, Control C, Control V that model, you know. And so the U.S. Federal Reserve, which was founded by the Act of 1913, what it does is to set the discount rate, something I'm going to talk about later, set the discount rate, the prime rate, which is the charge, uh, is the interest rate that commercial banks charge to the most credit-worthy clients, especially companies. Okay? It also oversees the national banking systems. It creates monetary policy, meaning printing money, and uh, it also buy and sell government security in the federal open market because it wants to achieve a interest rate called federal fund rate, a short-term interest rate, meaning a interest rate that 1 year or less. Okay, this short-term interest rate, the treasury, the federal fund rate, uh, is the rate at which banks lend fund each other overnight. So the Federal Reserve wants to achieve that target by buying and selling security in the federal open market. And since we're talking about is interest rate and loans, much like the stock market, the bond market, or this loanable fund market, the bond market is also affected by the state of the economy. So during a contraction and an expansion, there are several. The Fed use some of their monetary policy and all of their primary tools to preserve and to regulate the economy. So that lead me is to the market in terms and recovery here, right? Where um, well, with the market in turn and recovery, I see this contraction and expansion by looking at the historical data over the last 49 years uh, data, yeah, over the past 49-year data, and also from the market in terms and recovery. So the whole idea here is to understand from a bigger perspective how the market performs and see how you can make a well informed decision, especially if you want to hold long-term investment. And we're talking here is investment that you held for 1 year or more, or investment that you hold for 1 year or more. And again, so looking at this market contraction and expansion from the 1973, if you remember, during the U.S. Or the U.S. oil embargo made by the petromonarchy, because well, U.S. were supporting Israel forces, there, and that's a sensitive topic. That's more like a geopolitical topic. So I'm going to focus this on the financial aspect. Okay, and that's something interesting to talk about it. But right now, on the finances, in from 1973 to 2021 or 2021, there have been 10 market contractions that ends a stock market cycle, meaning a complete round of stock price fluctuation. And these fluctuations in these contractions may happen at random time and last for different time. So a contraction is defined when the stock market peak value fall 10% or more. And an expansion measure is the recovery of an index from the very bottom of the contraction from its previous peak and the subsequent performance until the next peak level reached before a 10% decline. So understand this. Perhaps this is very, very technical, okay? And you might wonder or you might think, well, why am I learning all of this theory? Okay? When you look now at this at data from Yahoo or Bloomberg, if you can have access, you can see not only where in the historical moment you are living right now, okay? If that is a contraction or an expansion, but also, again, make much more well-informed or took more, yeah, make much more well-informed decision based on the data that you know, okay? So what is a recovery and an index? Well, the recovery is the boom in price security following a long decline. The term is also used to describe the nation's activity economy. And the index, the whole idea of this statistical reference of investment in a period of time is to measure progress, right? So we have is the Wilshire 5000 index. Okay, you have this index which measures all of the public listed company stocks in the stock market. You also have something like Wilshire 3000 as well. This is another index. I think it's this or the best total for, yeah. Here is going to illustrate this index. What about this? Exactly. So the Wilshire 5000 index, the Russell 3000 ETF. You also have is the Standard and Poor, the Standard and Poor 500, where it shows you is the performance of the 5 publicly large company in the U.S. You also have is the Dow Jones, okay, the Dow Jones Index, which measure is the 30 companies in the manufacturing sector, in the industrial sector. But understand that all of this index exists is to make your life much more simpler and help you to know when you should invest. Okay, again, it's up to you. You should do your work, your homework, and then I look at the market downturns and recoveries. And this is the thing. This is the thing that struck me the most, right? uh, because with this, okay, because with this, because by looking at this downturn and recovery, which struck me the most, because here I look at how the U.S. equity market has. You look at this, okay? So how the U.S. market, how the U.S. equity market has crashed several times, and the most severe of that was at the beginning of the Great Depression in 1929. So the recovery period lasts 12 years. That 12 years, and the stock lost over 80% of their value, specifically 83.4%. More recently, you have, or more recently, the stock lost 44.7% at the beginning of the 2000 with the dot-com bubble, and the recovery took over 4 years, and it was the second largest in history. And then in the 2007 2008, during the debt and during the banking and debt crisis, the stock lost 50.7%, and the recovery it took over 3 years. Of course, all of this recession now has shrunk in time, but again, the question is, do you have 3 years of your time to hopefully let the market miraculously recover? No, that's right. That's right. Or perhaps you want, you have, you just have 6 year old, and then you say, okay, fuck that. You know what? But if you're in your 18th, 19th, 20th, right, or in your 30, 40, 50, waiting 3 years until the economy, the whole economy, repair itself, at least for me, is not a better stride. If you want to live your life and enjoy that, taste the sweet and the bitter aspect of the life. So that's the reason why I'm dedicating time to learn this. Okay, so there's a concept like the equity, where equity is the total amount of assets minus its liability. That's one definition. The other is the total uh, net worth of a company, or the amount of assets you own uh, for, from a company, right? In the context of property, which is when I dedicate a little bit of time to know and to understand this, all right, is is the total value of a property minus its liens, minus this legal right of someone else to possess your property until a debt is repaid or an obligation is met. For example, you have several types of liens, such as bank liens, when you ask for a loan in a bank for to purchase a car, for example. So they tie you a lien in case you are not able to pay or repay that loan. So they seize your car and sell it to repay the debt. right? You also have is the judgment lien, where this is often happen. This happen especially on sorry, on lawsuits, and the judgment lien can allow the demanding in a non-payment case to liquidate all of the accused assets, right? Okay, and for example, you also have mechanic liens, which is a guarantee to builders, uh, contractors, or construction firms to pay them for the service they offer. So these mechanic liens, uh, it can also be attached to a real estate property if the owner failed to pay for service rendered. It's for service rendered from a contractor, right? Uh, and if the client or if that owner cannot and won't respond or reply or don't give any signal of life to do that, well, you can issue a judgment. You can you can start a lawsuit against them, uh, and try to seize some of their uh, real estate property. Okay, so for example, another example of this mechanic lien is that when you ask for a loan to buy a house, the bank automatically issue a mortgage. You know. Also, you have is the real estate liens, that is the ability to sell your real estate if you fail a contract, right? And then you have is the tax liens, where now this is not based on a contract, but is on the law. And this is very common in law, or this is very common in taxation. So if a taxpayer is delinquent, so the tax authority can seize their house, their bank, can seize their house, their bank account, and their card, right? But ultimately, this is the last resort. This is an instance of last resort. They don't want to do that. Okay, all right. So that was very illustrative, okay? Because now you enter is in the realm of the law. You know, the lawyers here, the finance entering the realm of lawyers here with the liens. And it is very interesting to know that that might happen, okay? And now going back here to the market downturns and recovery, and the things to know is that stocks are prone to sudden loss in value for any different reasons. And then I look at the market downturns in recovery, or the bear and bull market, with respect to some asset class such as bonds, stocks, some other asset class, along with some sample portfolios. Except along with some sample portfolio structure. So here is when I look at the bond yields and Yeah, the bond yields during recession. So bond yields are driven by factors such as the supply and the supply and demand for loans, the monetary policy, and the inflation expectations. So the Federal Reserve has in its primary tools to set monetary policy the discount rate, okay, the discount rate and the uh, federal fund rate, okay, as it is primary tools to set monetary policy. So the discount rate is either the interest rate that the Federal Reserve charge to bank for short-term loans or the rate used on discounted cash flow analysis, which is this discounted cash flow or the expected discounted cash flow. What is this? Well, this is an evaluation methods to know the value of an investment today based on its expected future cash flow. And what is cash flow? Is the movement of money in and out of a company that because of that, okay, because of this term, and they can be categorized the cash flow from operations, investing, and financing. I asked myself, where did this data come from? So I look at the beginner guide to financial statement, okay, which this comes from the SEC, and it was very, very interesting because to me it was like, holy CRAP. It's like holy CRAP. Holy CRAP. Okay. Because now this is the realm of accountants and the finance, right? So we enter now in the realm of the accountant, okay? And the thing here is that I just want to know is the basics, which is that's why the SEC show off this data, okay? And understand the basic is very simple. It's they're rocket science because if you're able to read a nutrition label or a box score or or baseball, foot, soccer box score, you can read or you can learn to read the basic part of a financial statement. And if you can follow a recipe or apply for a loan, you can learn the basics of accounting. So much like the CPR class teach you how to perform a cardiopulmonary resuscitation, here what I'm going to look is how to read basic part of financial statements, but it won't train me to be an accountant. Much like when much like as CPR class or CPR course won't teach you how to be or won't make you a cardiac doctor, but it can give you confidence to be able to look at a set of financial statements and make sense of it. That's the whole idea. So let's begin by looking at what financial statement do. So from the SEC.gov, from the from the immortal lines mentioned by Cuba Gooding Jr. in the movie Jerry Maguire. So show me the money. Okay. So well, that's financial statement. Do they show you the money? When, where? So they show you the money. They show you where the company money came from, when it went, and what is it now. And these financial statements are for balance sheets, income statement, cash flow, and statement of shareholders' equity. Okay. So the balance sheet shows you what a company owns and what it owes at a fixed point in time. The income statement shows you how much money a company made and spend over a period of time. Cash flow shows you the exchange of money between the company and the outside world, and the shareholders statement or the statement of shareholders equity show you is the changing interest of the company shareholder over time. So I'm going to focus this on these three financial statement, the first three financial statement, and looking at the balance sheet that they provide us is a finance. They provide you. They provide to us a detailed information about company assets, liabilities, and shareholders' equity. So assets are anything that a company owns and has value. Okay, so this means they can be either sold. Okay, so anything that a company owns that has value, this either can be sold or used by the company to make products or provide service that can be sold. That statement is the holy grail of this, right? So that statement is the holy grail here, okay, of assets. It's something that a company owns uh, that has value, okay? It's something that a company owns that has value, and this typically means they can, this typically means that they can either be sold or can be used for the company to make product or service that can be sold, right? Or you sold this asset or you sold these things that you own, all right? Or you can make with these things product or service that can be sold. Uh, Learn the basics, mother. Learn the basics. Okay. So, for example, you can have this physical property, such as equipment, inventory, tractors, land, okay, and also intangible assets, such as trademark and patents. Cash itself is an asset as well, and so are investment a company makes, right? This is another asset. Again, something that it owns that has value. And then you have the liabilities, okay? You have the liability, which is the amount of money that a company owns to others, okay? Whether it is the payroll of a company, this can include all kinds of obligations like money borrowed from a bank to launch a new product, rent for use a building, money owed to suppliers for materials, payroll a company owns to its employees, environmental cleanup costs, or tax owed to the government. So this is all of the liabilities that can be. So it's money borrowed from a bank or loans from a bank. Okay, to launch a new product, rent for use a building. Renting is another liability. Okay, renting is a liability for yourself. Okay, but for someone else, it's an asset. Okay, someone that has value to them. Uh, Money owns to supply for material. Okay, money owns to suppliers for materials. Payroll a company owes to its employees. Environmental cleanup costs or tax owed to the government. Liabilities also include obligations to provide good or service to customer in the future. So It can summarize this liability to loans that you ask. So, uh, money borrow, money borrow from a bank to launch a new product, rent, renting a building, uh, money owns to suppliers for materials. Okay, again, money owns to suppliers for materials, payroll a company owns to its employees. Okay, payroll a company owns to its employees, environmental cleanup costs, or taxes owed to the government. Liability also includes obligations to provide good or service to customer in the future. And then you have is the shareholders equity. So shareholders equity is sometimes is called capital and net worth. Okay, so when you talk about shareholders equity is capital or net worth, right? And it is the money that will be left if a company liquidate all of its assets, yeah, or and pay off all its liabilities. So the leftover money belongs to the shareholders or the owner of the company. Okay. So understand the basics to me is something crucial. All right. Mm-hmm. So let me see the time here. I think we are good. I think we are good. I think we are good. Yeah, I think we're good. Oh. Mhm. Okay. Okay. Mhm. Mhm. A company balance sheet is set up like the basic account equation shown above. On the left side of the balance sheets, company lists their assets, and on the right side, they list their liabilities. Okay, so on the left side, the balance sheets, they list their assets. On the left side, they have their assets, and on the right side, it is liabilities. And shareholders' equity. Okay, sometimes balance sheets show asset at the top, followed by liabilities, with the shareholders' equity at the bottom. Okay, but this is the structure. Okay, this is the structure. So a company balance sheet is set up like a basic account equations show above. So on the left side of the balance sheet, so on the left side of the balance sheet, company lists their assets. On the right side, they list their liabilities and shareholders' equity. Okay, the net worth, the capital. So the amount of money uh, that will left, or the money that will be left if all the assets are liquidated and pay off all its liabilities. Okay, cool, cool, cool. Cool. hmm So, for example, is inventory. Okay, assets are generally leased based on how quickly they will be converted into cash. Current assets are things a company expects to convert to cash within 1 year. Mhm. And current assets are things a company expects to convert to cash. Yeah, assets are generally leased based on how quickly they will be converted into cash. And they are listed based on how quickly they will be converted into cash. So, for example, if I look at the balance sheets from McDonald's, for example, okay, they show you the total assets, okay, current assets, cash equivalent, exactly. So they listed like that. Inventory, prepaid asset, and other assets. Okay. So assets are generally listed based on how quickly they can be converted into cash within 1 year. Mm. You have cash equivalents, like cash and cash equivalents, and receivable. And they don't have that much cash, right? To be a multi-million company is like, what the fuck? You barely have cash. You barely have cash. What the hell? Okay. Inventory, prepaid assets, and total non-current assets. Net PPA, property, lands, improvement building, machinery, furniture, and other property. Goodwill and other intangible. Investment and advance. Long-term equity. But they don't display that data. Mm. Other non-current assets. Gross PPA. Okay, so assets are generally list based on how quickly they will be converted into cash. Current assets are things a company expects to convert to cash within 1 year. A good example is inventory. Most companies expected to sell their inventory for cash within 1 year. Non-current assets are things a company does not, non-current assets like this. So non-current assets, okay. Non-current assets include, non-current assets are things a company does not expect to convert to cash within 1 year, or that will take longer than 1 year to sell. Non-current tax include fixed assets. The fixed assets are those assets used to operate the business, but that's not available for sale, such as trucks, office furniture, and other properties. So, for example, my non-current assets that there are things that I cannot sell is a keyboard, mouse, a laptop, my cell phone, my power bank. Okay, there are things that cannot or that I use to operate my business that are not available for sale. Exactly. So these are the things that are not available for sale because allow me to operate this business. Okay. hmm Okay. A TLDR from assets here is so the following formula summarizes what a balance sheet shows. Okay. So the following formula show what a balance sheet shows is the assets is equal to liabilities plus shareholders equity, right? And a company balance sheet is set up uh, is set up like these equations, and on the left side they have, or yeah, on the left side company lists their assets, and on the right side the liabilities and shareholders equity. So sometimes balance sheets show assets on the top and followed by liabilities and shareholders equity, and assets are generally listed based on how quickly they will be converted to cash, liquid. Okay, how quickly they can be converted to cash. That's how assets are generally listed. So current assets are a thing. So current assets are things a company expects to convert to cash within 1 year. So the current asset. If you have this, you have current cash, right? Current cash. Okay. Okay. So now this makes sense a lot of that, right? So now this makes sense of a lot. So current assets are things a company expects to convert to cash within a 1 year. If you have cash and cash equivalents and receivable. So if you see yourself, okay, if you see yourself as a company, you might have a more easy life, I will say that, in the context of material conditions, right? Even though you like it or not, the entire system will push you to do that, right? And if you don't educate yourself, you don't do the thing that you know that you should do, doesn't matter. Someone else will do, and you like it or not, you will have to do that or comply. So luckily for us, we now have this internet thing where we can have access to that, and I can reply all of this method that I have learned, this systematic method of normalization of education, such as schedule, right? Interesting. So with this schedule, I can dedicate time to this topic, for example. Okay. Okay, so a company balance sheet is set up like this equation. Asset is equals to liabilities plus shareholders equity. And assets are generally listed in the balance sheet. You have assets in the right side, in the left side, and liabilities and shareholders equity on the assets on the left side, and liabilities and shareholders equity on the right side. So assets are generally listed. Okay, so for example here, they have is organized the assets followed by the liabilities and shareholders, like this. Okay, so they have that organized in this. Good. So current assets are things that are expected to convert to cash within 1 year. Okay, this is the thing that are expected to be converted into cash in 1 year. And total non-current assets are things that are needed for, are things that does not expect to convert to cash within 1 year, or will take longer than 1 year to sell. So non-current assets include fixed assets, and these fixed assets are those assets used to operate the business but that are not available for sale, such as truck, office, furniture, and other property. Okay. Okay. Cool. 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 Okay. Okay. So in my case, uh, since I have current assets or things that are uh, things that are expected to convert to cash within 1 year, okay, and non-curring assets, things a company does not expect to convert to cash within 1 year, or that will take longer than 1 year to sell. Do you have this? All right. Okay. Okay. Hmm. Okay. So you have this current assets. There are things that a company, myself, you can be you can see yourself as a company. There are things that can be used to convert, or there are things that are expected to convert to cash within 1 year. Okay, and non-current assets are things that a company does not expect to convert to cash within 1 year, or it will take longer to do that. Non-current assets include fixed assets, and fixed assets are those that are used to operate your business that are not available for sale. So in my case, laptop, keyboard, mouse, cell phone, clothes, uh, uh, food, shelter, internet. Okay, okay. Hmm. Then you look at liabilities. Liabilities are generally listed based on their due dates. Liabilities are said to be either okay based on their due dates. All right. In Spanish, is fecha de expiración. Liabilities are generally listed based on their due dates, and liabilities are said to be either current or long-term. Current liabilities are obligations a company expect to pay off within 1 year, and long-term liabilities are obligations due more than 1 year away. Okay, so liabilities are generally listed based on their due dates, and liabilities are said to be either current or long term. Current liabilities are obligations a company expect to pay off within a year, and long term liabilities are obligations due more than 1 year away. And I love how they organize this. I love how they organize this because it can give you is flexibility, freedom of choice. And then you have the shareholders' equity, right? Is the amount owner investment in the company stock plus or minus the company earning or loss since inception. Sometimes companies distribute earnings instead of retaining them. These distributions are called dividends. A balance sheet shows a snapshot of a snapshot. A balance sheet shows a snapshot of a company assets, liability, and shareholders' equity at the end of the reporting period. It does not show the flow in or out of the accounting during that period. Thanks. Okay, okay. So that'll be all for this video, and I wish you the best. Take care. Bye bye.